Welcome to Freightonomics, where we combine the freight market intelligence with that macroeconomic knowledge. I'm Zach Strickland, head of market intelligence. Anthony Smith, chief economist. We've had, I don't want to say it was a busy week. We had Halloween this week. And it's never really like, I feel like the end of October for transportation isn't necessarily like, it's more trick than treat most years to make a Halloween.
There weren't a lot of treats this year.
Not a lot of treats this year at all. But end of October sometimes can be a little surprising. We normally see a little bit of an uptick in activity. And it's always kind of a head fake, though, going into November. We had some more earnings calls come out, all kind of stating the same thing. The freight market is still not great for transportation service providers. For shippers, it's definitely a treat out there because they can source that capacity. But the writing's on the wall that's going to end at some point. I think Rachel Premack's article that she just wrote, we'll go over that a little bit here in a minute, but it really does a good job of stating, like, macroeconomically, everything's okay. But transportation-wise, it's not so great.
Yeah, and I think that's the big thing is when we're looking at, we talked about this a little bit last week, if you have a case for a recession, a case for recovery, or a case for resilience, you're correct in all three, depending on where you're operating in and what's happening in your industry. Even if you're in manufacturing, you could be looking at all three, but depending on what subsegment within manufacturing, you're having a completely different story on a year-over-year basis, respectively. And so when we're looking at that, it's all there. When we're looking at how long it could go, what's beneath the surface of it all, it changes drastically. So we're looking at, okay, consumers still spending, that's great. What's powering that? Of course, the labor market. But is that really as resilient as it seems? When you're looking at the job openings number, okay, over 9 million, that's great. But the rate of hires don't really follow that overall trend. And so, and we don't have that many Americans to work those jobs. So there's a disconnect there. And of course, service spending definitely playing a bigger role. There's just so many different intricacies happening right now that really aren't quite adding up. And if you have an argument for all three, you're right, depending on which segment you're in.
Yeah, I guess it's an economist's dream right now.
Oh, yeah, you can never be wrong. You just say it all depends.
All right, well, let's get first things rolling with our freight market in two, if you want to count me in here.
In 3, 2, 1, go.
All right. Every week, we give you a quick transportation market update, global supply chain update. This one will be more focused on that domestic freight market. I've got the CLAV, our contract load accepted volume, pulled up here, showing you a little bit of a bump up at the end of October, but it's down slightly starting November. If you look at this chart seasonally, the reason I pulled CLAV this work versus OTVI, this is accepted volumes. This is what stuff that has moved. So that makes it a little bit more comparable from a historical perspective. So this means no rejected tenders in this index. This is all accepted, and we're not that far away from 2021. If you look at the blue line at the end of September, and also, I guess, the purple line, which is 2022, we're not far away from either of those lines in the month of September, which would support this idea that economically speaking, consumer demand has been relatively strong. Inventories have corrected for the most part. And in a normal year, if you look at that orange line, that's 2019, which I don't know if is a truly normal year, we're well above that, even after the contraction in October. So economically speaking, from a historic perspective, we're not as bad as we could be. It just so happens that the market is oversupplied. Looking at the next chart here, this really illustrates it clearly. I shouldn't say clearly, but this is the OTRI versus NTI. So we've got outbound tender rejection index, still sub 4%. Looks like it's moving lower. And then we have the NTI, the spot rate index in fuchsia there. It is trending lower, a little bit of an uptick at the end of the month of October, but nothing really strong. And I think this has more to do with mixing than anything. No reason to think that capacity is corrected significantly. And the last chart to kind of drag this home, LOTVI, but mixed with all the other length of haul. The only one moving higher is that city freight, that less than 100-mile freight in orange going up, which is exactly why I think we saw the spot rates increase at the end of the month.
So when we're looking at that less than 100
Mhm.
moving up, what does that kind of tell to you? Because I know
Yeah,
there is that
that's
final mile, then there's that repositioning of freight, then we're talking about inventory levels. What's that kind of driving home for you?
yeah, it's interesting when I see a nuance in the length of haul. If we can pull up that chart real quick, and I can dive deeper here and why I think this is actually contributing to that NTI boost. Shorter length of haul stuff, higher rate per mile. So when that mixes into the NTI value, and again, this is not necessarily the NTI has loads, it excludes loads less than 250 miles, but I think shorter haul freight is definitely a big factor in this component because you have that month end sentiment where people are getting that upstream, that way upstream and way downstream freight moving. So you've got all the manufacturer type activity where they're getting stuff in the production process going between plants, between that parts manufacturer and the whatever the final production process is. Then you have the retail side, which is all that freight that's moving from the DC into the fulfillment center or into the store. That's what that COTBI really is representative of. It's that far upstream and that far downstream activity. And we had a big push of that at the end of the month. And I think that's probably why we see a little bit of that mixing because there's no other fundamental reasoning that I can see that spot rates would increase
Yeah.
at the end of the month, other than we probably had also a little bit of a sense of urgency to close out the month.
And I also have to mention, I'm going to be looking down from time to time here because I am going to be monitoring our socials. So I'm looking at LinkedIn right now. We also have YouTube and all other social media sites up. And we are live right now if you just so happen to be watching on this Thursday, Eastern Time, 12:07 p.m. And so if you want to join in on the conversation, you have anything to add, I want to shout out Interstate J. Thanks for joining us this morning. What's up? Join in on the conversation. You have a question for myself or Zach if you're seeing something in the market. So the question right now is, what is everyone seeing in their segment? What trends are you concerned about? What are you optimistic about, especially going into the fourth quarter or going into 2024?
Yeah, I think that's on everybody's mind is what to expect going into 2024. It's really hard to decode, that forward expectation.
Yeah.
But I think we can glean a little bit of understanding the current environment is always more important than predicting the future environment. Because if you don't understand the current environment correctly, you're not going to get to the future.
Yeah.
You know what I'm saying? So also there's a lot of information in the current environment that helps you predict the future. So how would you be? It's like not knowing that further upstream variable.
Right.
How are you going to know what the end product is?
Right.
It's
Yeah. And
basic math.
it's interesting because it's going to be one of those things. Like I said, what segment are you operating in? Also, we have Nicholas Stone. What's up, guys? Thanks for joining. So thanks for the shout out there, Nicholas. So one of the things that we have to kind of take into account is really what to expect, as you said. So one of the things that I look for, of course, is the canary in the coal mine, looking at what is going to be a leading indicator. And so,
Right.
of course, within manufacturing, I see that as a little bit of a canary in the coal mine. I love my flatbed.
I was going to say the ISM came
ISM,
out a little disappointing, did
it
it
dipped
not?
back down. Yeah, it's
Man.
still under 50. So no breaching that expansion just yet. And one of the things,
Talk about the ISM real quick. And I mean,
yeah,
ISM, the the Institute of Supply Chain Management. God, got me all across there. And of course, it is kind of an industrial
yeah,
manufacturing tool or data point that we look at. And it's like our LMI,
right.
anything above 50 expansion, anything below 50 contraction. And it's been hovering. It kind of bounced below 50 last year. Or was it last year or is it early this year?
It's been below 50
Yeah.
for the past 12 months.
Yeah.
But it got really close. So like I think it got to 49 percentage points just last month.
Right.
And now it went back down to 46.7. And so one of the things I always talk about with, first of all, I don't like to try to predict or forecast the ISM PMI because at that point, you're trying to predict people's sentiment
Right.
around a certain
Feelings.
industry. So don't look to predict people's sentiment at all. But what you can do is look to what are some of the conditions within it. So if you're going to try to forecast the ISM PMI, look at what's happening with new orders and look at what's happening with backlog of orders as well. Of course, you got to look at inventories, prices, all that other stuff as well. But those are going to be the three that I always look to first, and then kind of get into some of the other subcomponents after that. The big thing that I noticed in the previous one that really kind of gave me some pause and saying, hey, this is it, where we kind of are going to turn around for sure, was that the backlog of orders remained well below 50. So its most recent reading was at 42.2, and that's down from the 42.4. So it's well below that 50 threshold. Even though we start to see some momentum previously in new orders, the backlogs just aren't there. So there aren't just a substantial number of projects for people to
Yeah.
work through on that manufacturing side. And I think a lot of folks on the manufacturing side are just waiting. They're waiting for replenishment. They're waiting to put in new orders. They're waiting if they already pulled up
How much
capital
do you
good
think
expenditures.
they're waiting on the Fed
I
to
think
kind of
they're
give them a signal?
a good amount
Okay.
because I think previously in the previous cycle, we saw a pull forward on a lot of CapEx because there was that expectation that the
Yeah.
Fed was going to introduce a lot of quantitative tightening and that there was going to really start to increase interest rates from the FOMC. Now that we've seen that pull forward, I think there's a whole bunch of wait and see how 2024 starts to unfold. Are we going to see a pause continually, indefinitely? Is it just going to be higher for longer? Are we going to see a complete turnaround in those interest rates and it's going to be a sudden drop? I don't think that's going to be the case, but that's going to be one of the things that's going to be on a lot of people's mind is if they can just hold off on some of that replenishment aspect.
Yeah, guessing the Fed is a big part of what to expect in 2024 as well, because if they do actually stop raising rates, that could change things a lot. Or if they signal. I mean, really, everybody's looking for signals.
Right.
And good luck finding one that makes sense to you. So the industrial sector really ties in well with the LTL and our lead story today, which is where did all the yellow freight go? I love this story here. Basically, Todd Maiden covering this beat here now that we've kind of come through this yellow shutting down portion of the equation, but the LTL market has been it's been disconnected. Maybe that should be the title of the show today. Disconnections. Disconnected from the broader truckload space since the summer, really, when Yellow started having the public disputes with the union, et cetera. That's when things started really, falling apart, if you will. And so Todd Maiden, of course, puts together this tonnage month over month, year over year gain, these comps between all the LTL carriers, if we want to show that. And it shows that tonnage is up. I mean, this is sequential changes in Q3. Tonnage, you can see TFI, Saia, Old Dominion, XPO, average, all showed increases in tonnage. Tonnage is not sufficient to me, and by any means, when you're looking at LTL, because not all freight weighs the same or has the same density. Density is a huge component of LTL. So I'm looking at shipments too. And Saia, of course, shipment count way up. Their revenue also way up sequentially. This is very different than the truckload counterparts. So they're obviously getting a little bit of an idiosyncratic, movement that is very unique to them. And I think this is also helping them keep pricing a little bit higher than they would have seen. We looked at our background data. I actually wrote an article on it
Nice.
back in June when Yellow was first starting to have trouble. LTL was starting to see pricing come down, contract pricing come down, which most of the LTL market is contract, not really a spot market for LTL. But it stopped in June, and then it just kind of leveled off, and now it's actually on its way back up. So LTL, for those of you that aren't familiar, tends to have a much more disciplined pricing process where we see rate increases pretty consistently. Even in down markets, it's more like how little of a rate increase it is more than it is a rate reduction. And we were actually starting to see rates fall down, and now they're on their way back up again. So the LTL space looks like they've got, from a transportation provider standpoint, may have a little bit of a bridge or a length of time before they really actually get into what the truckload space has been feeling for 18, 19 months now.
Right. And we're looking at the type of industries that are being exposed or that the LTL market is exposed to. I always hear also a huge shout out to Andrew Bounds. Thanks for tuning in. One of the big things that we kind of have to talk to is what is really going to impact LTL market. So I always think of consumer goods. I think of some industrial activity as well.
A lot of industrial production
Okay.
activity, a lot of upstream stuff going on here because a lot of just in time going on upstream. But it's an interesting, far less fragmented. So that's another reason why they have better pricing discipline. And now they're even less fragmented.
Right.
Losing the number 3 national carrier is definitely going to have an inflationary impact to your rates in general. I think once the dust settles, though, Anthony, at some point, they're going to be exposed to the exact same downward pressure, and it's going to get competitive again. I don't know that I was thinking it might happen this winter. I don't know if that's true anymore. Depends on some timing issues and how all the implementation. It's very difficult to manage an LTL network.
Yeah.
Especially when you get these type of increases quarter over quarter. This data tells me that they're going to have significant network disruptions because of they're trying to ingest. I know that they have plenty of capacity, but it doesn't mean that the transition is smooth.
Right.
You know what I'm saying?
So let's talk about overall volumes real quick. So when we're looking at this time of the year, of course, we talk about seasonality and how much you can really start to plan around seasonality after COVID. Everyone looks to comparisons to 2019 as the benchmark of, hey, look, we're above 2019 or we're still below 2019, whatever the metric may be. But when we're looking at volumes right now and this time of the year, we're talking, of course, holiday season is here. What are going to be the expectations for volumes? Because one of the things that I'm thinking about is I've seen, and one of the things we've been talking about is, of course, multiple Amazon Prime Days this year, other retailers following suit. Then I've seen, we talk about Black Friday turning into Black November because it's just deals throughout the entire month. I've seen those holiday deals brought up into the end of October this year. And we don't see that hesitancy from where there's some international disruptions on getting stuff into the country from those shippers. There was that lack of urgency there.
Yeah.
And so when you're looking at that, what does that kind of tell you from the volumes aspect of this holiday season compared to the previous ones?
Yeah, I don't know that, demand to me during the holiday season is not really as important as the supply component for transportation providers, that is. But I think there is reason to be, from an economic perspective, there's reason to be optimistic that demand still, you saw the CLAV, it's down sequentially as it normally is from September to October, but it's not like falling off a cliff.
Yeah.
You know what I'm saying? Like even we saw a little bit of softness starting the month of November. That's very seasonal. But we typically see this in trucking and in transportation as these fall offs. If we looked at, I wish I had the IOTI, the maritime data, it's showing resilience. It is not falling below 2019 levels or anything like that at this point.
Right.
Doesn't mean it won't, because I think there's still a lot of, the debt situation is not the best. And that's another reason that I think consumers are not necessarily, that spending is a little noisy. You know what I'm saying? That 4.9%, we talked about it last week.
Yeah.
A lot of noise in that figure that nobody feels confident is going to sustain. But I think from a pure demand perspective, this holiday season looks okay. But transportation service providers will not notice it whatsoever. They didn't notice it just now. The next article that we have is the C.H. Robinson earnings report. C.H. Robinson, weak quarter as expected. So transportation, again, I showed you, demand is actually okay. But the trucking market itself is just, it's oversupplied. It's overrun with capacity. Total revenues were down 27.8% from the third quarter last year. Gross profits were down almost 29%. So there's a compounding effect of this contraction or, expansion in supply, however you want to look at it, that's diluting the amount of available freight out there. And in that, when you have less competition, you're also shrinking the amount of ability that you have to expand your margin. It's actually contracting those margins. And I'm not going to get into the contract versus spot argument just yet, but income from operations down 60%. Everything down. They cut expenses. Expenses were down 13% ish. Headcount was down 14-ish%. Everything's down, basically. And so they're trying to manage their way through it with this component of, can we also be ready for when the market turns? That was a big tell at the very end of this call. CFO Mike Zechmeister said basically they feel like they are well positioned for when the market turns up. Of course, he's going to say that. But you have to live in the moment today. Like if you don't survive today, the future is irrelevant.
Right.
And so I think this is it's a very hard ask to ask some of these CFOs and CEOs to say, hey, be ready,
Yeah.
but also survive.
Right. Yeah, and I think this is a similar mentality that a lot of folks are taking on. So many smaller operations, mid-sized operations were able to make a fair amount of money throughout the pandemic, sitting on some of those cash flows, and are just looking to, all right, all we have to do is survive until the market turns.
Yeah.
That's all we have to do. And so we get into this, this area where we start, okay, these are the new rates, people are accepting lower rates, it's just saturated, but everyone's just looking to survive until that switch flips.
Yeah, and you
But
want to be able to have that ability to like grab that freight when it's there.
yeah,
Because if you miss that early adoption, you miss.
yeah. And so when we're looking at that holding out to just make it to that next transition of the market, it seems like you're holding on longer than other industries would. So you're drawing down funds much slower than what you would have. And so instead of, just a sudden shift in the market, if it's a prolonged shift up,
Yeah.
there's going to be a lot of folks that have those bankruptcies, that have those completely shut downs because they just waited until the very last minute. Is that something that you expect to see more of going into the first
Oh,
quarter?
it's a hard balancing act, especially from freight because the margins are so tight.
Right.
Like you're basically trying to make sure that you have availability for when the market does turn, which does appear to be decently off in the future. But it's like when.
Yeah.
Timing is everything. Timing is so important. The last article that I think is very, it ties into your expertise quite a bit as well. Rachel Premack, Americans are getting, I'm sorry, that's the one about, oh yeah, there we go. Americans are getting spendy again, but it's not ending jaw-dropping trucking bloodbath.
Yeah.
And this just speaks to that whole, the trucking market, there's too many trucks, there's too many carriers, but she speaks to the fact that Americans are still buying a lot of stuff. Do you think that that's accurate, that statement, that they're still buying as much? Or is there a little bit of noise here?
So I think they're still buying. I think they're buying more services on a year-over-year basis. I think that's 100% a big thing here. Of course, I always mention Taylor Swift, Drake, Beyonce, the three big ones that are just touring and just collecting their paychecks and moving, GDPs.
Right.
But I also think that we're looking at things like, so for example, the U.S. Census Bureau, amazing information. One of the big ones that they put out, retail sales, of course, not adjusted for inflation. So I do think there is definitely some noise in that inflationary aspect there. There is a deflationary aspect to the real GDP number, but I do believe that is probably lower than the actual real rate of inflation right now. So I think there's even some noise in the adjusted inflation for the GDP potentially there.
Right.
So I do think that consumers are continuing to spend. I think they're continuing to use that credit card. As you always mention, using of that credit card is more expensive because of these elevated interest rates. And so that debt costs more. So when we're looking at the consumer, they are active, unfortunately. It's not what I want to see because I would love to see the consumer to spend just enough to, of course, not lead into a complete crash in the market and the macroeconomy, but definitely not to put them into a position of financial overextension.
Do you think that this inflation has made it too difficult to actually evaluate some of our traditional economic figures that are based on dollars? Like I think that concerns me more than anything with that 4.9%. I feel like if you apply too much generalized inflationary value to the GDP figure, that's still not enough, right?
Oh, 100%. And so that's when I started looking at some of the other ways to analyze the data. So I start looking at, of course, the year-over-year trends. Of course, it has some inflationary aspects to it, but I start looking at rate of growth, 12-month moving average, things like that.
Yeah.
And so that's when I can start looking at the overall trend. Even when we're looking at upstream aspects like durable good orders, measured in millions of dollars, when you're looking at CapEx spend and things like that, that's going to have an inflationary impact to it as well. And so those are some of the different aspects to really kind of take into account when you're looking at those numbers At best, try to put it into a year over year or maybe a 3-month moving average, quarter over quarter. Look at those trends and then compare those year over year trends compared to maybe the rate of inflation comparatively within your segment.
Yeah, I don't trust money right now for sure. And of course, she speaks to the idea of capacity as exiting the market at a record pace right now. I think she estimated about 35,000 carriers over the last 12-month cycle have exited the space, but nobody can tell. And that's because there was 100,000 of them that grew.
Substantial. I'm a big fan of Rachel Premack and all of her. She puts out so many, like, she makes an actual story. I wish I had her writing talent, though.
I know. And yeah, she does a great job. Came from Business Insider, and we appreciate that. But yeah, it's going to take a while.
Yeah.
We're still in it.
We'll see you all at F3.
Yeah.
Get your tickets. Live.FreightWaves.com. Drink more water.